One Step Ahead by Lundquist and Beslick.
Hello and welcome to One Step Ahead Radio. This is a new session this week, and as usual, please tune in and listen to us. This is one of the best ESG sustainability updates out there, not least because of the times we live in, and these are the times that we will discuss a bit today. After the new installation of the second time in this role president in the United States, and of course the aftermath of what is to be expected, given the dire situation I think in many ways the world is in. James, welcome again, and I hope you're doing fine.
Yeah, hi Sasha, good to be with you here again. Lots to talk about at the moment, the start of this. It's like, what are we going to talk about for such a short time? We've just got so much is happening at the moment that is relevant for sustainability and ESG and what's happening, gyrating the world around Washington. And so it's going to be good to share some thoughts about what we think about what's going on.
I think the world is sort of a trembling in a way, and also trying to understand. The questions have been many. What's next? So what is going to happen now? We know what has happened 2 days ago, or yesterday actually, or the day before. But the question is, what are the repercussions for the world going forward? I mean, for millions of people around the world, these last couple of days of, I would call it a clown circus in US, was still and is in many ways entertainment when it's at its worst. And for other millions of people, this is more of a vengeance moment to celebrate and enjoy. The question is, how do we sort of move forward? James, any initial thoughts on this one?
Well, I mean, I was kind of struck with the comment from the president of Mexico, Sheinbaum, who said, well, it's not so much what gets said, but what gets done. So I think, trying to filter between what's actually is the bluster and the performance and the verbal onslaught of not just from President Trump, but all of his entourage, compared to what's actually going to happen and what's actually going to happen on the ground. I mean, there are some things where the US president can actually make direct action, and actually, he has a lot of power with controlling both houses as well. So, but I think, her sort of statement was a bit that, let's actually see what gets done and then we'll see how to react to it. I think it'd be interesting to hear, in Davos, various world leaders coming out and starting to make some sort of cautious statements about how to respond, and everyone saying we're ready to respond, we've been preparing, everybody knew that this was coming. So it's like, so it's not like the first time around they said, oh my God, we're going to have tariffs. It's like, okay, let's talk. And I think there's it's a bit of a time for negotiation.
It's and I completely agree with you. I mean, it's not the first time. We've been expecting big words and also anticipating some of the actions. And one of these things that it's very interesting to follow is this extraterritorial tax system that has been put in place with this agreement that happened a couple of years ago, I think, on the global sort of corporate tax. This is something that Trump administration is withdrawing from. And it's probably one of the tools that European Union could use, for instance, in relation to companies like Tesla and many other American companies, to sort of gain in taxes which are not sort of paid to European Union today. Do you think that this sort of a tariff tax discussion going forward, I mean, also in relation to renewable energy, electrical vehicles, competitive advantage to a certain extent that Europe still has, do you think that this will also be on the agenda sort of after these first couple of, what they call it, 100 days of power?
Yeah, I know it's an Anglo-Saxon thing. We always love to talk about the first 100 days of power. It's like in the British press, and it's like, it's always like this key marker of what's going to happen in the first 100 days. But no, definitely the tax thing is very interesting because of the backdrop of a lot of governments with high levels of debt and needing to find sources of income to pay for increasing their military spending seems to be the number one objective at the moment, but also, paying for, as you say, the energy transition and building factories and infrastructure. All that needs to be paid for somehow. So if business isn't kind of paying a fare, apart from business, but also the most wealthy, paying a fair share, then that's going to be scrutinized, and I think could be, a very important bargaining chip. It's certainly something that's already been played out a lot in Europe in terms of what's a fair contribution. So I think, you find that these various issues, defense and taxes and tariffs suddenly kind of connect into some kind of deal, because it's all about a deal, right? So
it's all about making the deal. The question is how Americans will make a deal with the climate change consequences happening in their own country. There is a recent report that's been published a day before Biden left the office, which is related to insurance costs in the US, and homeowners in the United States are facing an enormous financial crunch due to the climate risk. Many struggling to find insurance or even dropping premiums that are soaring due to the mounting toll of wildfires, hurricanes, and other disasters. And that is the latest government data from the US. The figures, the most comprehensive number ever released by US Treasury Department on the issue, which is quite interesting to follow, show insurance premiums are increasing quickly across the country, with people living amid the greatest climate-driven risk experiencing the steepest rises of all. In 4 years, look at these numbers, to 2022. People living in the top 20 riskiest places for such perils paid on average 82% more than those in 20 lowest climate risk zip zones. I don't know about this new administration, given the fact they are withdrawing from a Paris climate agreement for the second time. But how will they explain this to people that have to pay, 82% more for the insurance premiums because they are hit by climate change? It's very difficult to make a deal with climate change. I don't know what your thoughts about this are, James.
Yeah, it was very much the reaction from the United Nations this week when, among one of his first executive orders, President Trump withdrew from the Paris Agreement, and obviously the response was, well, climate doesn't do deals and doesn't think in 4-year terms, and doesn't really care about who's in and who's out. It will continue, and the science is clear, and I think that kind of message was reinforced by the kind of numbers that you're talking about, and the kind of very real impacts that we're really starting to see, and that Americans, along with everybody else, is seeing that it's actually going to cost. And I think an administration that's very much driven by the bottom line, very much driven by the dollar, and the key question going to the election was, do you feel better now than 4 years ago, right? Do you feel better economically? So that's going to be the question that people are going to ask in 3 years and 10 months time, when the next presidential election comes around. Are you better off? So those kind of costs are really going to hit people, and really going to make it feel very, not just the physical impact, which obviously is very important, but these repercussions are going to really be starting to felt. And I think that's something investors are going to be very attuned to, and they'll sort of be pricing that in pretty quickly, whether they believe in ESG or not.
Yeah, it's believing in the acronyms or definitions, or believing in the real impact that will affect many businesses around the world, their products and services, the way how they can operate. It's not really related to the acronyms; it's related to the valuation. And
absolutely,
as we know, many of our investors around the world are focusing on this, but in Europe, which is the leading ESG sustainability investor in the world, with about 80% of assets in these kind of products compared to the rest of the world, there has been some movements. There have been movements in terms of what's going on in the US. Now, the European Union is likely to scale back its highly contested ESG reporting requirements, since France prepares to unveil a formal proposal seeking to limit the scope of this regulatory framework. The French government is readying a new set of recommendations intended to rein in the Corporate Sustainability Reporting Directive, and may present its proposal as early as this week. according to persons that are familiar with the matter, who's not authorized to speak publicly, and this is at least what Bloomberg is reporting. The development means the two of EU's biggest economies are now pressuring European Commission to make cuts to CSRD after German government last month urged to block executive arm to scale back the directive. Now, is this really a pushback which is related to the US, or is this something, James, that it's more sort of a European thing? There has been a big debate with Draghi report about the, competitiveness of European Union and also a lot of bureaucracy around this. I tend to agree that we should cut bureaucracy and focus on where it really matters and where ESG can actually make commercial strides and make companies to develop solutions that will address these challenges. What's your take on that one?
No, it's very much a dynamic that we've already seen last year and already pushed back on the CSDDD. So the due diligence directive was already accused of putting excess onus and bureaucracy onto companies. For example, the German government talking about the middle-sized companies being hit by that, and the French proposal, according to the article that you were citing, there's a lot of when it comes down to it, they're talking about keeping, maybe proposing the same framework, but reducing the number of companies that are involved. So raising the number, for example, of the employees, not as small as 250 employees, but going maybe up to 1,000, which would cut down enormously the number of companies actually involved. So those larger organizations would still be involved in the CSRD as it stands today. And in fact, some of those companies have been lobbying Brussels to stick to their guns, to keep it. So, companies like Nestlé say, we've already been investing in
so much in this,
much in aligning to it, getting our suppliers on board, cascading this, everything. Now, like at the 11th hour, you suddenly say, the first reports are coming out in the next weeks, and now all of a sudden you say you're kind of rethinking it. So there's also a cost for companies in terms of the uncertainty of saying, well, hang on, what are we going to be subject to, when, and which companies? But it's kind of, I find it sort of misses the point a bit about the CSRD. Kind of as you were saying before, there seems to be this sort of presumption that if from on Brussels' side for years, that more transparency, more data, more indicators is somehow automatically going to drive the sustainability agenda and change business models and help it create value out of that. But the way we've been seeing companies, starting to adopt it, I'm not quite convinced that that kind of quality of data and quality of insights that's going to be useful for markets is going to come out. So
I agree. I mean, look, there is this sort of a almost El Dorado question in the investment world, and that is how companies actually make money on sustainability. Unless you are sort of a pure, clean-cut renewable energy company, the rest of the businesses around the world are still answering that question to themselves. Now, not to be very negative on the developments in the world, because we have had a couple of very nasty days behind us, let's sort of end up this session with positive news. And the positive news, regardless of the new administration in the US or other types of autocratic sort of feelings around the world, energy startups have overtaken the makers of electric cars and batteries as the top global climate tech investments for the first time since 2020. This is a big news. And the big news is this because this comes as an overall climate tech investment has dipped 2024. So this part of investments is increasing, and they've done so as the growing demand for artificial intelligence has driven interest in technologies that can power data centers with less emissions. Venture funding for global energy startups total at $9.4 billion last year, representing an increase of 12% from 2023 levels, according to a report published this Tuesday by Sitelight Climate, a market intelligence platform. Among them, funding for geothermal startups, which is a very interesting thing, nearly tripled to $558 million, while nuclear investment almost doubled to $1.9 billion. James, obviously the energy need going forward in our world will increase by 50 or 60 or 70% in the next couple of years. So we will of course follow the trend and see if we can update the audience for One Step Ahead Radio with the latest news. And as we said before, it has been a couple of tough days. Of course, we still don't know the full scale of repercussions related to sustainability investments and around the world. But what we can be certain about is, as you said earlier, and I would like to sort of quote you on that, is that there is a resistance. People are defending what they believe in, and we can hope that that will continue. James, many thanks for participating today and giving us your views, and to everybody else. Please listen to us on Spotify, share it with your friends, family, neighbors, and networks so we can get more people engaged in the topics that we are covering. Many thanks, and I wish you all the best.
Thanks, Sasha. Have a good day, everybody. Goodbye.